Samit Ghosh, the Managing Director and CEO at Ujjivan Financial Services, has joined us. Mr. Ghosh, good afternoon. Thanks so much for joining. I heard a bit of your chat with Tamal at the conference. Is that right, that you want to stick with microfinance? You don't want to really diversify too much by way of your asset franchise?
No, I mean, it's not that we are just sticking to microfinance. We want to serve the unserved and underserved, and to that extent, we are moving from the group lending business, which is the predominant business today, to more on micro and small SME finance and affordable housing. And we think that is going to provide us the growth in the next 5 years. So to that extent, we are going to, our asset book, is going to change.
So, Samit, hi, good afternoon. Microfinance has been one of your strongest segments. I mean, even in the quarter gone by, you saw a whopping 63% growth. So when you say you're going to improve the growth run rate, what do you mean? Can you better the 63% portfolio growth that you're seeing currently?
No, I mean, see, in the next, while we go through the transition, we don't want to grow at a very accelerated pace, But the composition of our growth in the next 5 years will change from pure group finance to, the individual lending which we do for micro SME and for, the affordable housing side.
So what is the breakup now? How much are you lending to the SHGs?
Today, 87% of our portfolio is group lending. Only 13% is in this side, And we expect over 5 years that the portfolio will almost equally be divided between these two types of businesses.
And as you go towards individual lending and SME and affordable housing, will that start to tell on your returns? What will your yield be? Because, I mean, SHG, you all make a much bigger yield, don't you?
Yeah, we do make a much higher yield in a sense, but, the cost structure is also high. The ticket sizes of loans for the micro and small business and affordable housing is going to be larger. So, the operating costs from that point of view will drop. Even though your, the interest revenue will be lower than what is there for group finance.
Okay, so can you give us some numbers? I mean, what is the margin you are working with now? When you become 50-50, what will your margin be? What is the cost to income now? I think the cost to income now is 45%.
No,
what will it be when
50 something?
Okay, what will it be when you become 50-50?
Cost to income.
Yeah.
The cost to income in the next 2 years, because we are investing very heavily in the transformation process in terms of technology, infrastructure for branches, people, etc., it will go up. It will go up to 60 plus levels or something. And then we expect it to drop down, maybe slightly around current levels.
Okay, so that's on cost to income that will rise and then perhaps drop later. What about your return on equity? Because there is an expectation that that could, trend to somewhere around 13% or so by about FY18. So it could trend lower. Is that a reasonable assumption as you transition to a small finance bank?
See, I can't give you the exact numbers, but I can tell you that both, the return to equity and return on assets during the transition again will drop from our current levels, and it will come back, but I don't think it will come back to the high levels which we were there, as a successful NBFC.
Of course. Okay. Well, just give us the kind of margins you are looking at, the broad numbers you are looking at. I'm not asking you for exact ROEs. As well, even on margins, if you can tell us at the moment, I guess your cost to income, your cost of funds would be, low double digits. How much might it fall to in the years to come as you build up, small deposits?
Well, immediately, Lata, after we convert to a bank, our funding costs will go down to a certain extent because currently we borrow around at 12%. So it's going to come down a little bit because the interbank rates are lower, etc. And then, it will, as we build up our, build up our, just
Yeah, go ahead.
build up our retail deposit base, right now I can't just give you the numbers, but maybe sometime later I can give it to you.
All right. Mr. Ghosh, it's always a pleasure speaking with you. Thank you very much for joining us with those details. Okay, so at the moment, the Ujjivan franchise or Ujjivan model is really borrowing at perhaps 12% because they're largely borrowing from banks. But then when you have SHGs as your big borrowers, the margins tend to be very good. So in any case, it's a very good, very handsome return on equity, even when it dips a bit.
Okay.